Okay, so let's move into our financial planning topic, and that is how to maximize your tax brackets. All right, and so I'm just going to reposition myself so I can draw on this. So you're going to see me moving around. And if you're just joining us, this is the Financial 15, of course. All right, the Financial 15 is the last 15 minutes or so of our weekly webinar, and this is where we talk about our financial planning topic. And if you're just joining us on this section on YouTube, please be sure to like, subscribe, and hit that notification button. And be sure to share it with your friends if you think that folks will find this interesting. So let's start with the why. Why would you want to maximize your tax brackets? Many attorneys, or excuse me, many CPAs will say, and again, most CPAs are rear view mirror looking. They look in the rear view mirror of what you did last year, and they say, okay, we're going to report on this, and maybe you should make some contributions to an IRA or something like that to minimize your taxes. But it's really about what happened last year. And many CPAs, if they heard me say, well, if you're in the 24% bracket already, and you're interested in tax efficient planning, you might want to fill up all the way to the top of that 24% bracket. They might say, whoa, why would you want to do that? Well, why would you want to do that? Let's just give a quick, I promise, tutorial. Remember our buckets. So we have your taxable bucket, and you all are experts, and you know this now, tax deferred bucket and your tax-free bucket or tax advantage bucket. And your taxable bucket is, we get 1099s all along for every year for interest, dividends, long-term capital gains, short-term capital gains, etc. And all that equals tax. You must pay tax every year, and we're going to touch on that a little bit. And tax deferred is your IRAs, your 401ks, 403bs, etc. All of those that you've promised to pay tax on at a later date. Now, we all know and we all believe, and we have the evidence and the math behind us, that taxes have to be significantly higher in the future than they are today. And if you believe that, and if that's been shown to you, and when people say, well, I don't know if that's the case, I always say, well, I've got about 12 reasons why I know that taxes have to increase dramatically in the future, if not double by 2030, around there. Just give me one good reason, one reasonable, substantiated reason why taxes are going to be the same or less. And nobody can really I've never had anybody really be able to do that. So if we know that, we want to identify how much money we should have in each one of these buckets, and what's the ideal amount. And then everything else should go into this tax-free bucket, right? Because tax-free is anything is truly tax-free is Roth. And again, tax advantage or tax-free, whatever you want to call it, or properly structured cash value life insurance. It's not municipal bonds. It's got to be free of, to be truly tax-free, free of state tax, federal tax, capital gains tax, and does not contribute to your Social Security being taxed. So once you determine how much you should have in this taxable bucket, most people say 6 months to 1 year of expenses. And some people can keep some money in this tax deferred bucket, absent any other income. You should have an amount that generates an RMD that is less than, is that word to be there? Less than that's greater than, okay, an RMD that's less than your standard deduction. And if you're able to do that, then you don't pay any tax on your required minimum distribution. Now, I talked about that in a video some time ago, a few weeks ago, or maybe a few months ago. And if you have a question about this strategy, then you should research that video. Everything else then, once you identify how much should be in your taxable bucket and how much should be in your tax deferred bucket, then everything else should be moved over to the tax advantaged or tax-free bucket. So then the question is, well, how do you do that? Because the cost of moving from tax deferred to tax-free, and even taxable to tax-free or tax advantaged, is, of course, tax. So you must pay tax to get to the tax advantaged buckets. My friend and mentor, Ed Slott, would say you want to move things from forever taxed, right? These are forever taxed. These two. To never taxed. I love that, but it really is never taxed again, right? Because you have to pay tax to get there. So this is where the art comes in. Many people say, okay, I get this idea of converting to Roth IRAs, and I'm not going to get into I could easily fall into that trap of getting into the details of that. But if you want to move money from your IRA to a Roth IRA, you can use this tool called conversions. We've talked about this in depth. The question is how much and for how long, right? That's kind of the art of it. So I want to talk about how we get there. So is that amount that you convert this year $100,000 or $1 million? You know, it's all dependent on what your needs are, what your tax situation is, how long you're going to be in that tax situation, and so on. So we're going to talk about that. So I hope you all understand the why you want to shift as much money as possible, the right amount, to this tax advantage or tax-free, because anything you take out of here, these tax advantage buckets, is zero tax. Anything that you leave to your heirs that's in these buckets is also 0% tax. And if we know that taxes are going to significantly increase, you know, if your effective tax rate now is 20 to 22% and taxes double by 2030, and that's a really good point in time to pay attention to with the problems we have, economic problems we have in our country, then it's pretty easy to see that your average middle-class American is going to be in a 40 to 45% effective tax rate, probably by around 2030 or so. So if you're not comfortable paying tax at those rates or higher than where you are today, you want to come up with a plan to shift to tax-free or tax advantaged. Now, here are all the things we have to pay attention to, and we're going to get into this a bit. First of all, we're talking about taxable income. People often ask that is, well, am I basing it on adjusted gross income or modified adjusted gross income? No, we're talking about taxable income. So you've heard my theory about and my thoughts about your retirement team. You want a qualified CPA on your team. We're tax planners, but you want a good qualified CPA to help you with these calculations and help us. You know, what the CPAs really do for us is help affirm those calculations. So that's good. So we're working on taxable income, not adjusted gross income or modified adjusted gross income. They come into play in other areas, but not for what we're talking about today. Long-term capital gains and qualified dividends are taxed differently, but still have tax due. So although they're taxed differently and they don't fall into the same calculation as your taxable income, if they're qualified dividends or long-term capital gains, if they're ordinary dividends or short-term capital gains, they absolutely are treated as ordinary income, and they fall into these marginal tax brackets that we have over here. We're going to talk about in a minute. You also have to consider IRMA, income-related monthly adjustment amounts. If you're over 65 years old or on Medicare, receiving Medicare benefits, you have to pay attention to income-related monthly adjustment amounts because it's an additional cost of taking the steps to be tax advantaged. We have developed a great calculator that helps with future tax and IRMA calculations, so we can walk through that with you. Other tax credits. This is a big one. How about the electric vehicle tax credit? Now, that's up to $7,500. What if that really made a change for you? If many people come and we're doing a financial plan, and they say, I want to buy a car in, the next 2 years, the next 5 years. Well, one of our questions we've added to our questionnaire now is that an electric vehicle? Because there's a potential tax credit that we may not want to interrupt, right? And if we go over now, the new rule this year says if you go over certain thresholds, then this tax credit begins to go down and it gets eliminated. So these are the things to watch out for. We talked about the why, and we talked about some of the things to pay attention to. Now, how do we calculate this? All right. So I'm going to share with you. This is the form that you can download from the website. Go to attleborowealth.com, go into the slot corner like I showed you, and you can download it. You should download it. I've got this on my desktop. Of course, everybody in the firm really has it on their desktop, and we review it all the time. So these are from Ed and his group. I always give him credit He puts these together every year, and I really appreciate it. We're going to be focusing on these 2023 tax rates, and we're going to talk about capital gains rates. But I drew them out because one thing, and I meant to bring this to the group's attention last time when I was there, they've flipped this upside down, and I don't like it. They start with the lowest rate, and they go to the highest rate in ascending order. Is that right? I like it this way, where you start with the lowest rate and you go to the highest rate. So while the numbers are the same, and I wanted to show you where I got the information, there's a lot of good information on this chart, not only capital gains rates, but trust tax rates. Gosh, this is so important. A lot of people ask about trust. That's a big one. Standard deductions, this is in here. Qualified charitable distributions, good information here. And then there's some Roth conversion planning ideas. So that's always good too. But let's focus on these tax rates. So let me change my color of my pen for a moment. We'll make it green for money. I like that. So we've got two different filing statuses, married filing jointly here and single over here. Now the percentage tax rates, these are the percentage marginal tax rates. You'll see that these are the same whether you're married filing jointly or single. So people will say, well, once you're single, your tax rate goes up significantly. Well, it does. Your percentage doesn't necessarily change. This doesn't change, but what you're seeing over here are income amounts. So these are dollar amounts. I put dollar, I put percentage, and I put dollar. But these are your taxable income amounts. So these are after adjustments, after deductions, whether you itemize your deductions or you have standard deductions, where you land, this is how you're taxed. And it's progressive. So from $0 to $22,000, if you're married filing jointly, you don't pay any tax. If you're a single filer, well, it's half of that. It's $11,000. And once you cross over $11,001, well, now that $1 is taxed at 12%. So unlike people say, I've now moved into another tax bracket, it doesn't recapture all of your income that was down here. I'm sorry, you pay 10%. Did I say 0? I think it's 10%. You pay up to, that's right. So you would pay that first $22,000 if you're married, or $11,000 if you're married filing jointly, or $11,000 at 10%. It's just that next bit. So if it's $12,000 or $23,000, it's taxed at 12. So I hope you understand that. We'll move on. So if, for example, you had, let's say you stop there and you're at $23,000 of taxable income. Well, it may make sense for you depending on your situation, because again, remember, we identify how much we have in these accounts, and then we identify how to get them over here to Roth and what that schedule should be, and what that tax rate's going to be. And this is why I say the gift of the Roth conversions is you get to choose the tax rates. So let's just move forward with this example. Let's just say you have $100,000 that you want to convert from your traditional IRA to a Roth IRA this year. Now, and your taxable income is $23,000, and you're married filing jointly. And we're going to add $100,000 to that. Now let's add this up, and let's just kind of come in where we think $100,000 might be. And we know that that's going to be into the 22% bracket. So you might say, all right, well, that takes me now through the 12 and into the 22. Well, that might be too much. If it's only $100,000, you might say, you know what? Let's stop at the 12. Let's put a hard line on the 12 this year, and we'll move the rest of it next year. And that might be a good strategy for you if you only have a little bit to move in your IRA to your Roth IRA. You might be able to say, okay, I'm going to take it right up to the top of the 89, the 12% bracket. And then next year we'll have a schedule for moving the rest of it. And we won't even be into that. We'll be back into the 12% bracket, right? Because if you go up to 89, that's only going to leave you about, what is it, 50,000 plus if there's no growth in that IRA, but you've got plenty of room. And so you're going to convert most of that money to Roth. Yeah, Roth at the 12% tax bracket. So that's pretty good. But let's say that you have more than that, or you're concerned about tax rate risk, or you're married and your spouse is ill, and then suddenly you're going to be in this, these lower income thresholds, and you say, I want to push that right up to the top of the 22. That might be a good strategy for you too. So we push up into the 22% bracket, and we've got some Roth conversion being done at 12 and some Roth conversion being done at 22%. Now, what if you have $1 million in your IRA that you want to convert over time, or you need to convert over time, and you want to convert almost all of that? Let's say you can leave $200,000 in there, or your magic number in your Roth, or your traditional IRA is 0, and your schedule looks much different. You might want to say, okay, for just 2% more, so just 2% more, I can go all the way up to $364,000, and I'll convert some at 12, some at 22, and some at 24%. And that's going to give us a blended rate. And let's just average that. It's probably going to be somewhere about to 19 to 20%, and a blended or effective tax rate. So I hope that's all making sense. This is how you maximize your tax brackets. You figure out the amount that you want to convert from your Roth IRA or your traditional IRA to your Roth IRA. And then you do the calculations to figure out what works best for you. Now, remember, if you do it too higher significantly in the future, I'm not sure what's happening here. Hoping I didn't lose anything. Okay. That tax rates could be much higher in the future, or that you could lose your spouse during this. Now, I hate to tell you, but when you go into retirement together, one of you is going to pass before the other. As soon as that happens, your income thresholds change very quickly. Remember, we could go all the way up to the top of the 24% bracket to $364,200 this year in taxable income. That drops all the way down to $182,100. So if I'm looking at a couple who are in their mid-60s and early 70s, and I'm doing a Roth conversion strategy, that's always in the top of my mind, right? Not back here, but up here. That's always in the top of my mind, is that eventually one of these folks is going to pass before the other. It's very, very likely that one's going to pass before the other. It's highly unlikely that you're going to go at the same time. And as soon as that happens, really the following year, we have much lower thresholds. And when single people come to me to do Roth conversions, it is certainly more challenging to get this work done, because we don't have the gift of the top of the 24 bracket, top of the 24% bracket at $364,200. So if you're inclined to move forward with tax efficient planning, and you're fortunate enough to still have your spouse with you, boy, you've got to maximize those brackets. Don't be afraid of the 24. Don't be afraid of the 32, depending on the amount of money you have. But you certainly want to calculate that, right? And make sure that addition, that 8% more makes sense. 2% is almost a no-brainer. But hey, if you can get it done in the 22%, I'm back here. If you can get it done in the 12% bracket, all the more power to you. I think all three of these are really good options if you're considered middle class, because again, the average middle class American, we believe by our calculations, are going to be in the 40 to 45% effective tax rate, probably by 2030. So use these tax rates that we have now to your advantage. If you're married finally jointly, certainly take advantage of them. Don't be shy about pushing up. You want to do these calculations. Make sure that you're not triggering capital gains issues or IRMA. And we're going to come back to that. And that's not IRMA. This is IRMA. And that should all be part of the calculation. But that's how you maximize your tax brackets. So I hope that all makes sense. Now, let's just briefly talk about long-term capital gains and ordinary capital gains tax. Now, this is calculated differently. I'm talking about long-term capital gains and I'm sorry, this is qualified or ordinary. It should be qualified. Qualified. Let's fix that. So long-term capital gains and qualified dividends tax. So that falls differently. It doesn't flow into, they don't flow into this calculation. So if you have $100,000, let's say you do a Roth conversion and with your taxable income, you end up with $364,200. And then you have an additional $100,000 in long-term capital gains or qualified dividends. That doesn't stack on top of here. That's not what happens. That would be short-term capital gains and ordinary income or ordinary dividends. Yes, sorry. So they fall into that graduated cylinder, right? We refer to this as a graduated cylinder, kind of like the money flows in like a liquid does in science class. So ordinary dividends and short-term capital gains fall into that, but not long-term capital gains or qualified dividends. Long-term capital gains and qualified dividends have their own set of tax brackets. So it can be 0, 15, or 20%. Now, let's look back at this chart. And you can see here, they jump pretty quickly. So married filing jointly from 0 to 89,250. You don't pay any tax. This is modified adjusted gross income. Now I know it's confusing, and that's why you should have that team working with you. A single filer is 0 to 44,625. Once you cross over 89,251 to 553,850, you're at the 15% tax rate for capital gains, right? Qualified dividends and long-term capital gains. But pay attention to that asterisk. I'm going to come back to that. Married couples or single couple or single people, 44,626 to 492,300 at 15. Over $553,000 in modified adjusted gross income, you're at 20%. Again, for the asterisk, I'm going to talk about that. And over $492,300 for single filers, you're at the 20% tax rate for capital gains, long-term capital gains, and qualified dividends. So why do I bring that up? I'm going to come back to these asterisks. That's net invested income, and that adds another 3.8% on top of these rates. So this could be 20 plus 3.8%. And this is from the Affordable Care Act surcharge. Some people call it the Obamacare surcharge, but that could be an additional 3.8% for each one of these for long-term capital gains or qualified dividends. So pay attention to that, because even though that doesn't calculate into your Roth conversions or tax efficient planning, folks, if you have $100,000 in qualified dividends or long-term capital gains, and let's just use this section here. If you fall in this threshold, that is another 18.8% in tax. And the math is easy on that. That's $18,800. So that is an additional tax that's going to be paid. And whether it comes from this table here, right? I'm up here, or this table here, both of those come from your checking account. So you've got to, or your investment accounts or your money. So you've got to include that in calculations. I hope that makes sense. So what triggers this net investment income? So anything greater than, again, this is modified adjusted income, anything greater than $250,000 for a married filing jointly couple. That's this year. These can adjust as the tax tables can adjust. $200,000 for single filers, $125,000 if you're married filing separately, and $14,450 for trust and estates. Whew, okay. So that's a lot of information. Here's what I want you to come away with. It's the idea of shifting money from taxable to tax deferred to tax advantage. You can go this way. Is kind of a simple idea, right? It's okay. I get it. I identify what I need. Now I'm going to move that over to Roth. I'm going to move it over. Maybe cash value life insurance is part of your plan. I don't know. And you could figure out, well, we could just go up to here. You first had to figure out your taxable income. You first had to figure out, what your potential taxable income is going to be for this year. Sometimes we do it all at the end of the year, do these conversions all at the end of the year. Sometimes we do them throughout the year or early in the year, depending on what your income flow is. If we're not expecting bonuses, things like that, it's a little easier. But you have to consider these other costs. So any tax that comes from capital gains. It's a little easier, believe it or not, with short-term capital gains and ordinary dividends because it flows into this graduated cylinder. But you've got to add that if your budget is $50,000 in tax and you take it right up to the line so that you're converting enough to just generate $50,000 in cash, and then suddenly you have capital gains that you weren't counting on. And sometimes that happens with mutual funds, as many as you know, and you have no control over that. And now suddenly you have to pay another $10,000 or $20,000 in capital gains tax. Well, now you've blown your budget, and this is an area where people hit frustration. You can also trigger things like your IRMA might cost you more in it, and you don't understand, or it doesn't make sense the benefit of maybe paying more IRMA now and not paying it later. So that might be an effect on you. You might lose a tax credit, like we talked about. There's several tax credits, but this electric vehicle one is a new one. So while it might be simple, it's not necessarily easy. But I just wanted to give you some things to talk about. This isn't an instruction to say, okay, now this is how you do it. Go ahead. I wanted to impart on you the difficulty of this process and some things to pay attention to. So remember, mired filing jointly as opposed to single filers, that's a big deal. That can be a reason to have a more aggressive schedule in Roth conversions, because you're both not going to live forever and you're likely not both going to go at the same time. So one of you is going to be stuck paying higher taxes potentially due to the fact that the other person passed away. Don't be afraid to test the schedule, the marginal tax rates, to see where you're going to, that tax that you're going to pay based on that. Don't be afraid to feather it down. Also, there are plenty of times that I'm pulling people off the gas. Sometimes I'm pushing them on the gas, but there are plenty of times I'm saying to people, we don't need to go that aggressively. And folks, you have to look at this every year. You reevaluate it every year to see what your conversion or what your tax efficient strategy should look like. All right. It is now 11:02. I think we've said enough for today. Jerry, I can answer that question offline. Jerry's question is where the funds to pay taxes on the conversions come from upfront versus paying from available cash. That depends on the individual, right? Where your funds are and how much you have to pay and what your comfort level is. I hope that was helpful. I'd love your feedback on that. I hope you all have a great week. I won't see you next week, but I will see you the following Tuesday. And we're going to talk about these different indices and what the heck they mean, the S&P 500 and the Dow Jones Industrial Average and the NASDAQ and how they're formed and how they're tracked and more about that. So look forward to seeing you then. Have a great week. I hope you explore our website a little bit. And if you have any questions, reach out at questions@attleborowealth.com. That's questions@attleborowealth.com. Take care.